introduce Michael Arone. He's the Chief Investment Strategist for State Street Investment Management. Michael has over 30 years of investment management experience with leadership roles in portfolio strategy and quantitative equity investing. Today, he helps lead the market strategy and thought leadership efforts for the team's Spire ETF efforts. So this morning, his presentation is titled Uncomfortably Bullish, where we're going to explore the forces that drive the markets higher in 2026 while addressing the valuation pressures, structural shifts, and resilient EMC challenges that we're all facing throughout the day. So with that, please give them a hello.
Thanks, Tyson. Appreciate it. Good morning, everyone. First and foremost, thank you for taking some time. I appreciate that it's all a busy time of year. We were chatting with a few folks before breakfast. I know there's some graduations, maybe family members, friends, things like that. College graduations, high school graduations. It's a busy time of year. So I'm incredibly grateful that you've taken some time to join us this morning. Krishan Nigam, who's with me, who kind of covers the area for our U.S. wealth management business, had mentioned that I was at this meeting a couple of years ago, or a similar meeting a couple of years ago. So first and foremost, I never get invited to come back to any place a second time. So the fact that you guys invited me back, I'm like blown away. So thank you so much for the repeat invitation. A few things before I kind of take you through our outlook. And so first and foremost, extending my gratitude. The second thing is what you'll find in my approach. Tyson was kind enough to mention I've been in the buy-side asset management industry for about 30 years. I know you're shocked, given my boyish good looks, that I've been in the business that long. I view that as a short amount of time, and that I learned something every day. What drew me to the markets was a great deal of curiosity, and I approached it with a great deal of humility. Many are familiar with the old market adage that if you don't know who you are, the markets can be an expensive place to find out. And so I approach this with a great deal of humility. Now, trust me, I'm going to give you my opinion, my conviction, or our opinion, our opinions and conviction. But I do approach it with a great deal of humility. Markets are complex and dynamic, as we know. The other thing is although this was set up, I don't do death by PowerPoint. If you actually saw me a couple of years ago, I very rarely use slides. I understand for many, a picture can tell 1,000 words, and we have all kinds of content in our chart pack, and it's available to you. But this morning, we'll largely have a conversation about our outlook from that perspective. And then finally, if you have questions, let's get them answered. I'll do my best to answer them in terms of, get my attention. I'm happy to answer questions along the way. Throw something at me. As long as it doesn't hurt me, I'm fine. And we should have an enjoyable conversation this morning. So our outlook, it's funny, Tyson mentioned, we had our outlook for 2026 was titled Uncomfortably Bullish. Now, Kevin Marsh is here in the room. He's on our select sector team. Krishan's here. They're going to be just as surprised as you are. You all have some good timing in that we're in the process of writing our mid-year outlook. And I'm going to give you the preview of that mid-year outlook. They're going to get it. The problem is they're going to tell me, well, Mike, the title you gave at the CFA thing is a little different, or this or that. So it's still a little bit in motion. So I rarely refer to notes, but I have a couple here. So our mid-year outlook, we're switching from uncomfortably bullish to resilient fundamentals and rising fragility. It's Italian, in case you didn't recognize. All right, so that's our outlook. So outlook title. So let me share with you what we're thinking for our mid-year outlook without further delay. So if you're into doom scrolling, this has been a good year for you, right? Investors who are anxious and into doom scrolling, it's been a good year. And the reason why I say that is there's been some outrageous and some bizarre headlines that have certainly impacted market volatility and investor sentiment. Of course, the Department of Justice criminal investigation into the Federal Reserve and Chair Powell, in particular, for his comments before Congress about the renovations to the Fed's headquarters. That was an odd one. How about some European nations symbolically sending troops to NATO, to Greenland, to defend it against the threat of President Trump taking over the island for national security reasons. That seemed a little strange. More seriously, of course, the unexpected breakout of the Middle East war between U.S., Israel, and Iran at the end of February. Those are just a few. For those that like to doom scroll, that could kind of really increase the anxiety, get the heart pumping, and kind of get that doom and gloom component. And of course, there were likely a few others along the way. Now, what's interesting about all that is that many of those things could have threatened what has been a pretty healthy bull market since the lows set back in the middle of October in 2022, but they didn't. So yet the multi-year bull market, despite all that, I'll actually do a slide to make Krishan happy. Despite all of that, returns, these are returns across asset classes. You can't see it, which is partly the reason I don't do slides. As, large cap stocks, developed stocks, emerging markets, bonds, there's all commodities. The green represents the last 12 months. The blue dots you probably can't even see, and those types of things. But you can see largely returns, despite those fears, are up across most asset classes. So I can guarantee that your social media feeds will be continued to be populated by outrageous headlines that kind of, not make you feel bad, but kind of feed into the whole doom scrolling. I can guarantee that. But ultimately, I think what's happened once again is that markets have proven that it's not the headlines that drive returns, but it's the underlying fundamentals, use that term loosely for now, that ultimately lead to these returns. And those fundamentals have been pretty strong. So I'll go through a few of them. I'll balance this a little bit of backward-looking versus forward-looking throughout these comments. But overall, despite, again, as I said, I can guarantee you your social media feeds will continue to make you anxious. But if we can look beyond that, the fundamentals, the foundation for this multi-year bull market remains strong in our opinion. Those are those resilient fundamentals. So let's tackle a few of those things. The economy in the first quarter, the Bureau of Economic Analysis released the first estimate of GDP for the first quarter is 2%, annualized rate of 2%. That's much better than the 0.5% in the fourth quarter. Of course, that 0.5% in the fourth quarter was driven by the longest U.S. government shutdown in history, cockroaches in the private credit area, and skepticism around, or growing skepticism around AI, for example. So 2% in the first quarter, not a robust pace, but certainly not contraction. Today's Atlanta GDP now estimate is about 3.7% for second quarter GDP. Look, I know it's not going to be 3.7%. You know it's not going to be 3.7%. It's literally a model that generates that figure that's updated based on economic data, and it's likely coming down. But what I can say is it's not a recession. It's not a contraction. So the economy continues to expand. So when I think of those fundamentals, the economy expanding, not contracting, that's a pretty good thing. The second thing I think about is earnings. So earnings season, Q1, is pretty much done and dusted. More than 90% of S&P 500 companies have reported, and I don't know if there's enough superlatives to describe the earnings season. I don't know if you all believe, kind of feel that. So S&P 500 earnings year over year growth through the first quarter, 27, almost 28% on revenue growth of more than 11%. When we look at this, 84% of the S&P 500 companies delivered a positive earnings surprise. 80% delivered a positive revenue surprise. Both those figures are above their 5-year averages. When we look kind of under the hood to see kind of, who were the winners and losers, technology. The sector delivered more than 50% earnings growth year over year on revenue growth of 29%. So I think one of the biggest stories of the first quarter earnings season was that all those AI fears that surfaced back in November, I don't know if they've been put to rest, but certainly they've been kind of addressed in some way. The fears that all this spending would have this big negative impact on earnings and revenue growth has not materialized, at least so far. And technology has been the clear, in a way, winner. Now, what's also kind of interesting about this is, for all we hear about concentration, as it relates to earnings, they're not concentrated at all. So 7 economic sectors delivered double-digit earnings growth. 6 of them delivered earnings growth year over year of 20% or more. All 11 sectors delivered year-over-year earnings growth. And profit margins, net profit margins, have never been higher. So for all the fears that tariffs and the oil price shock would begin to cut into margins, again, so far, I get it, it's not fully baked in, have not materialized. So since FactSet has been keeping the metric, the net profit margin metric for S&P 500 companies, it only goes back to 2009. The number has never been higher than it is today. Companies continue to do more with less. And productivity, when we look at it over the last few quarters, continues to be elevated. This may, in fact, give incoming chairman Kevin Warsh the air cover that he's looking for, potentially, to cut rates later this year. It might be the last best hope for him to do that, given some of the other data that we've received. Now, when I look at this, kind of some of these other elements, when I look at the outbreak of the Middle East conflict and its impact so far on interest rates and core measures of inflation, at least so far, and I think this is the biggest threat to the rally, is that they've been somewhat range-bound in the first few months of the year. So 10 years are creeping towards 4.5, certainly keeping an eye on that, and we can talk about what some of those risks are. But given the earnings growth that companies have delivered, a 4.5% 10-year Treasury yield isn't problematic at this point. Of course, CPI came out yesterday, and the top-line number was accelerated, 3.8%, largely driven, not all driven, but certainly a considerable part of that was the inflation dynamics from the oil price shock. When we looked at core measures, right, ex food and energy, because who needs those things anyway, it was around 2.8%. So again, I'm not saying that inflation's defeated. I'm not saying that price change level isn't high and it's not a problem. But at 2.8%, it's not a problem when companies are delivering close to 20%, 28% earnings growth. And we're seeing that kind of breadth of delivery in terms of earnings and revenue growth and profitability. Could it become a problem? Possibly. So I do think that perhaps one of the bigger threats to the bull market would be an unexpected rise in interest rates. That could come from a reacceleration of inflation and or the fact that most countries continue to spend wildly without a way to pay for it. Of course, we're keeping an eye on the headlines in the UK, for example, and that could push up term premiums and long-term interest rates. So interest rates are rising most everywhere. And so that is something that could be a threat and something to keep an eye on. But at least in the first few months of the year, despite the oil price shock from the outbreak of the Middle East war, rates and inflation have not proven problematic. Now, all of a sudden, I add in the AI CapEx boom that continues. That's been a benefit. I add in a lighter touch regulation environment that's had a positive impact on places like energy and financials and potentially healthcare. That has had a positive impact. A resilient consumer. So I think, again, one of the themes here is that there's a lot of the sentiment indicators that consumers are in a bad mood. Right? So I think the University of Michigan came out with a preliminary estimate just the other day, and it was terrible. Right? So all the consumer sentiment measures. But when we look at the hard data, the retail sales spending and other figures, it continues to demonstrate a consumer that remains resilient and continues to spend. So when we look at those things, kind of AI CapEx, spending boom, we look at a resilient consumer, we look at lighter touch regulation, they have all further flattered the gains that we've seen so far this year. Now, looking a little bit more forwardly, North America will be hosting the World Cup soon. And so, again, some might not chuckle. I've just seen this. I think this came from Bank of America. I think I was looking at the badges. Someone may be joining from Bank of America. I just saw a research piece that'll add $17 billion to the U.S. economy, hosting the World Cup soccer tournament. Again, $30 trillion economy. Is it market moving? No, but it's certainly positive. And there were a number of other statistics. I think in the last World Cup, 6 billion people, something like 60, 70% of the world's population engaged with the World Cup. North America is hosting it. It should have some benefits in terms of kind of where folks go to watch, tourism, attending some of the matches, all those advertising, all those types of things. Add in the celebrations for the 250th anniversary of the signing of the Declaration of Independence. So if there are any NFL football fans in the room during the playoffs while you were watching it, already the football had the 250. Already there were commercials, and those will continue throughout. So this should boost some optimism, some spending, some programs that are in place. Finally, and somewhat, I get more questions about the risks, more questions around the index impact, which I'm not an expert on. But we're also anticipating in the second half some of the most highly expected or anticipated, I use that word twice, IPOs that we've seen in years. SpaceX, Anthropic, OpenAI, Anduril, I don't know, sorry. So all of these, Underall, I don't know, and I'm just making up stuff now. Many IPOs are in the pipeline, a slate of them that will also feed into some of the animal spirits. So when we kind of put these things together, we think the foundation for this bull market, this multi-year bull market that started back in October of 2022, continues to be resilient, continues to be strong. And as we look forward, despite some of the kind of headlines, we think that will likely continue. That's why we described ourselves to start the year as uncomfortably bullish. So now there is some things that I think of as kind of a broader structural change that's happening. Maybe this is a little bit more CFA appropriate. I don't know. So the way I kind of think about this is investors, I think there's kind of a likelihood that the bull market will endure. However, given and deliver returns above the rate of inflation. Good news for investors. However, I do think that there is a somewhat slow-moving but seismic structural shift in the economic and investing landscape that many of us have grown up in or studied about. That framework has existed for the last 4 decades. And so, I don't know exactly if we want to just describe it as globalization. And here's the other thing. What's interesting is this has now become en vogue. Everyone seems to be talking about it. And Krishan and Kevin are here and things. I feel like when we met 2 years ago, we had a conversation along these lines. I've given presentations. I have a presentation from 2018 that talks about politics, policy, and populism that kind of begins to pull on some of these threads that I'm going to share with you in a minute. But now it's in vogue. Everyone's talking about it. But I do think that there is this shift from globalization to something different, and it has impacts for how we allocate assets. And I believe that it's slow-moving, but it's big, structural. It will last a long time. And I think it requires tweaks to how we think about asset allocations. And I think that in many ways, investors, should they not make these meaningful changes, are ill-prepared for what comes next. So kind of with that as a headline, I think of this as kind of efficiency versus resiliency. So I'm not going to take us too far down memory lane, but let's chat a little bit about kind of that framework in terms of globalization and kind of really how it's impacted the economic and investing landscape over the last 4 decades. So when I think about kind of globalization, I think about events like the fall of the Berlin Wall, 1989, the dissolution of the Soviet Union, 1991, the signing of the NAFTA in 1994, and China's admittance to the World Trade Organization in 2001 as examples, as events that are signature events of globalization. And so globalization certainly set on an element of kind of multinational supply chains, advocates for free trade, corporate efficiency, kind of all of those things, right? The U.S. was the world's kind of provider of global national security It set forth an element of a peacetime dividend between the world's nuclear-armed superpowers. And when I looked at it from an investor, right, when we kind of observe it from an investor perspective, it set forth a period of falling interest rates, benign inflation, rising corporate profits, and a great deal of efficiency. Now here, again, I'm not here to defend globalization or attack it. I'm here to kind of look at what's happened and the impacts and where we may be going in an objective, unbiased view. So that was kind of the framework. And when I think of that framework, and I think about the types of investments that worked during that time, you know, when rates were falling, inflation was benign, corporate profits were rising, we're all about efficiency, global supply chains, global cooperation, free trade. What worked then, 60-40 worked just fine. U.S. stock performance largely has dominated over that time period. Growth stocks, of course, longer duration assets as interest rates fall and inflation is benign. Long-dated fixed income was outstanding. We had a 40-year bond bull market from 1982 to 2022. Credit, of course, worked exceptionally well in that dynamic. So that kind of sets the framework for kind of globalization and some of the things there. So what are we moving towards? So here, I'm not exactly what to call it. I don't like to think of it as the new world order. It sounds too too ominous, right? So I think we're shifting to something different. Some have categorized it or described it in more ominous tones, but I think it's a natural shift. And when I think of events from this perspective, so when I talk about slow moving, a long process, structural, I'm not sure exactly when this started, but I can think of Crimea's annexation in 2014. I can think of Brexit in 2016, Trump's first election, right? So what had it started to happen, of course, is after decades of globalization, like everything, it had pros and cons. And some of the negatives started to surface. And these events started to happen. The annexation of Crimea, Trump's first presidency, Brexit, the breakout of the first trade war between U.S. and China in 2018, the pandemic. Again, not that the pandemic was a result of deglobalization, but it certainly exposed the notion of global supply chains and having more than 30% of the world's manufacturing output in a singular country that doesn't play well nice with others. And so that was a symptom of kind of this structural change. So that was 2018, 2019, of course, the pandemic, 2020. Of course, Russia's full-blown invasion of Ukraine in 2022. That set off an element of kind of an oil price shock. Trump's second election. Now, questions about central bank independence. We talked about debates over Greenland's sovereignty for national security. The UAE is leaving OPEC. Questions about the future of NATO, right? Complaints that our allies didn't step up when we needed them. And again, I'm not debating whether you believe that or you disbelieve it, but these are kind of events that are unfolding at this time. U.S.-Israel, Iran conflict. So these, in my mind, are all symptoms of this shift in towards deglobalization. And so when I think about that, when I think about the impact of we're moving more towards national security, less global cooperation, more fragmentation, less free trade, more restrained trade, or negotiated trade. Everybody's spending on global defense. Right? Everyone's not that they're going it alone, but everyone is increasing their spends. The U.S. has made it clear they expect their allies to kind of spend greater amounts to defend themselves. We're no longer going to be the world's kind of national security power, if you will. So there's a number of these things that are unfolding. So it's all about national security, about resiliency, about resource nationalism, about AI supremacy, capturing technology supremacy, which would be key. So when I think about those dynamics, and I think about kind of what the implications may be for investors, you can think about some of the kind of opposite reactions to what happened during globalization. So interest rates may be a bit higher. Inflation may be a bit stickier under this structural change, this slow-moving, seismic change that I've been describing. Defense spending has certainly gone up. Trade will likely be kind of renegotiated from that perspective. And it will become less about efficiency and more about resiliency. You think about the corporate profits and kind of corporate efficiency, that could be shifting to something different. So that, in my opinion, has meaningful implications for how we allocate portfolios. So if 60-40 did well and US dominated growth stocks and long-term bonds and credit, we may need to make tweaks. Now, we're all good CFAs or studying to be CFAs. I'm not suggesting we throw out 100 years of investment history or data on the 60-40 and diversification and correlation. That would be naive, that would be wrong. But what I am suggesting is that tweaks are required in the new regime to potentially prepare for some of these things. And so when I think about this more meaningfully, I think maybe greater allocations to international and emerging markets. I'm not suggesting that we back up the truck. What I am suggesting is I have the privilege of meeting with a lot of different clients, and most US clients have either significantly underweighted international and emerging markets or have thrown in the towel, depending on kind of where they are and kind of who their clients are, that type of thing, and they don't own any or very little. And all I'm suggesting is that it may be time to pare back those underweights and add some more exposure given some of these shifts. When I think about the income that a 60-40 portfolio delivers, the dividend yield on the S&P 500, given some of the dynamics in terms of the large technology companies and how they allocate capital to shareholders, the dividend yield on the S&P is 1%. It's rarely been lower. When I look at the income, the yield for a 60-40 portfolio, I think it's around 2.3%, 2.4 maybe. Well, we talked about inflation is at 3.8. So the income from a globally diversified portfolio is losing purchasing power. And so this has real implications for bond allocations at a time when we expect that interest rates will likely remain elevated and more volatile. The fiscal wiggle room that all these wealthy countries have to increase spending without raising taxes and cutting benefits, it's not an impossible problem, but it is a political problem that it has a solution, but one in which folks are not pursuing. And we think that this has the potential to raise long-term interest rates. So simply extending maturities to gather their income, we think is risky. So the ag certainly has a yield that's above the rate of inflation, but its duration profile is unattractive in our opinion. Credit is also maybe no picnic or no easier with credit spreads where they are. Some of the headlines from private credit, again, I'm not saying private credit's a problem. What I am saying is that it's quadrupled in the last 10 years. A lot of new entrants have come in. A wider breadth of users have used private credit. As there's been an element of getting that capital to work quickly, due diligence and credit analysis in some instances probably was a secondary objective. And given just the size and growth, there's bound to be a few hiccups along the way, and that's what we're observing. And you put it in a vehicle that isn't as liquid as anticipated, and you get headlines. I'm not saying there's anything wrong with private credit. Again, the economy's expanding, profit margins are high, interest coverage ratios seem reasonable, default rates seem manageable. But I'm not surprised, given the massive growth that we've seen there at some of the headlines that we're now seeing. And so credit continues to be a challenge. So on the fixed income side, it's perhaps the most problematic portion of a global asset allocation. So we've been encouraging investors to use a lot of active management. So the three of us represent State Street Investment Management. In many instances, we represent Spider Exchange Traded Funds. So that may seem strange coming from us. But over the years, we've partnered with folks like DoubleLine and Blackstone and Apollo to try to bring active solutions to the market in an ETF wrapper. And so for us, we think that being on the shorter duration side of the curve, where I can generate yield above the rate of inflation without taking on too much interest rate or credit risk, using active management, makes some sense. Maybe using some things to help on yield enhancement or manage risk, like private credit. So again, it may have seemed like I was building a cautionary tale, but one of our ETF solutions actually uses private credit as a lever to manage risk or generate return, for example. So we think that this continues to be a challenge. And credit, we still kind of are favorable on, but again, we think being active in that space makes a lot of sense. Perhaps you agree. When we think about this, again, as I said, the economy is expanding, earnings are growing, profit margins have rarely been higher, interest coverage ratios seem fine, default rates seem manageable, but spread compression is not going to generate return. It's all about carry. And so selection is critical. So that's kind of the way we think about fixed income. But perhaps the biggest change that I've been an advocate for years is around boosting the resiliency of portfolios, primarily through a few different things. I think the big headline here is a greater allocation to real assets. What I would consider things like commodities, natural resources, precious metals like gold, real estate, infrastructure. Now, what's been interesting is, and again, I like to joke, I get tons of things wrong, but one of the things I do is, I go on the media, go on TV every once in a while, and we have clips of me talking about gold at 1800, telling folks to do this. For the last couple of years, I've been trying to get folks like Rashawn to think about our diversified real asset ETF as a solution to this change. And it's performed incredibly well, incredibly strong. But today it's now in vogue, right? And now everyone's like, oh, of course, in hindsight from that perspective. So the way I think about this is that in the dual pursuit of massive fiscal stimulus in response to the TMT bubble bursting, in response to the global financial crisis, the mortgage crisis, the pandemic, in all those instances combined with extraordinary monetary policy, correlations among asset classes in many instances have changed. And we saw that in 2022. And stocks and bonds went down together. We saw that at Liberation Day. Stocks and bonds went down together. We saw briefly during the debates on Greenland sovereignty. Stocks and bonds went down together. We saw this in March. Stocks and bonds went down together. So we put them, because we're good CFAs and diversified portfolios, because we expect that they have low correlation, that they'll help us diversify, that one will zig while the other zag. I don't know if you saw that on your CFA exam, but that's why we do it. And yet, it seems to, at least in short bursts, have changed. And so, my view is that as long as the economy's growing and earnings are growing, then stocks are the place to be. And they're a good inflation hedge. And I told you up front, when I listed all of those things that I think support the solid foundation for this bull market rally to continue, that stocks will deliver a return above the rate of inflation. They're volatile. There'll be some hiccups along the way, but given the kind of the foundation that I built, the economy and earnings and the consumer and the World Cup and all that stuff, we think there's a little more room here for us to go, for this bull market to continue. But bonds under these conditions continue to be a challenge. So even 2022 forward, many times cash has beaten bonds in the last few years. But now all of a sudden, if inflation's at 3.8 and cash is yielding something less than that, I'm losing purchasing power. So I need something to help me. And I think real assets may be that something to provide diversification, income. So I know gold doesn't provide income, but infrastructure and real estate do, tips do. those types of things. So it's those things that we kind of think about. And adding them, I can, depending on what I choose, what I add, I can get an income that's commensurate with bonds or higher, and I get a better kind of hedge against elevated rates and inflation. And I lean into many of the structural changes that I've outlined: the resiliency, the global defense spending, the AI CapEx infrastructure boom. All of those things, these investments are beneficiaries of, in my humble opinion. And I think they deserve a greater allocation. Now, nobody does 60-40 anymore, but if we use that as a starting framework, maybe it's something like 60-30-10 now. And that 10 is in a diversified basket of real assets that generates some income. So I think that has been a good shift, but I think it's this, as I said, this kind of slow-moving, but seismic structural change that's unfolding that requires tweaks at the margins to traditional allocations in some of the ways that I mentioned. And so that kind of is the message. We often, I won't go through these because we've hit a lot of them. So I mentioned our outlook is likely to be titled something like Resilient Fundamentals and Rising Fragility. So I think we went kind of through that when I went through the case for the continuation of this bull market, the logical case. And we went through the fragility part of the efficiency and resiliency discussion in the shift. We tend to think about this idea of separating the market mood from the market reality. That's kind of the macro framework I wanted to kind of set up for you. And then we think in themes, so diversify for a new regime with multi-asset strategies and real assets. That's kind of what we just talked about. I will mention, when we think about multi-asset strategies, Krishan told me to stay away from commercial stuff, and I will do that. But I'll provide it in an element of context. So a little more than a year ago, we partnered with Bridgewater to launch their all-weather portfolio in an ETF. I'm not selling it to you, won't sell it to you. I won't even mention the ticker. But you talk to Krishan or to Kevin or to me after if you want. So many of you are familiar, of course, with Bridgewater's all-weather strategy. It's a multi-asset strategy. They try to diversify differently. Their whole mantra is prepare, don't predict. They believe they don't have any edge when it comes to forecasting kind of returns and things like that. And they simply allocate 25% of global equities to inflation-linked bonds, to treasuries, to commodities, and things like gold. And ultimately, this is a CFA room, I don't want to get into all the mechanics. They're using some leverage to lever up the bonds to target a volatility profile around 12%. And they believe its correlation relative to traditional stocks and bonds is around 0.5, 0.6. And they believe that whether the economy is expanding or contracting or inflation is rising or falling, they should be able to deliver a positive return. So we partnered with them, we launched it, and it's performed very well relative to stocks, bonds, real assets, etc. Given not surprisingly, everything I just described from that standpoint. The reason I'm giving that context is we believe that when I talk about a multi-asset strategy and this structural kind of underpinning, this change that I've been describing, this is a strategy that kind of fits that mode, if you will, in addition to those real assets. Sorry for the sidebar. When it relates to equities, it sees opportunities created by economic fragmentation. So there we talk about allocating more to emerging markets, or to small cap stocks, or to defense companies, and also to technology companies that are on the forefront of the AI CapEx spending. So again, I'm not going to go through our product lineup, which you're going to be happy about, but we have kind of ideas for that. And then finally, when it comes to fixed income, it's prioritize income and resilience with active short duration and multi-sector credit. Exactly what I described when I talked about our fixed income kind of outlook, for lack of a better term. So all of you have just received a preview of State Street Investment Management's mid-year ETF market outlook. We've covered a lot from a macro perspective, some themes, some ideas, and at this point I'm happy to take any of your questions. Yes, sir.
2 questions. First of all, you're mentioning kind of increasing allocations to international emerging markets with the S&P 500, like with revenue, about 50% is coming from international economies. So how should we consider, the revenue from U.S.-based companies in the international and emerging markets exposure? And secondly, if earnings reports go to semi-annually, what implications do you see for the markets to adjust to that?
Yeah, absolutely. So the first one, of course, is just making sure I think everyone heard around. Look, S&P 500 companies generate, I think, almost 45% of their revenues from outside the United States. Technology in particular is a big one. Right? So one of the things I kind of failed to mention during the globalization talk is one of the other things that happened were kind of globalized, like kind of industrial, like kind of more globalized, coordinated industries and technology platforms was another kind of outcome of globalization. And of course, the revenues generated by the S&P 500 outside the US have climbed alongside globalization. Right? And so there is an element where you are getting some of that exposure. And so when I might actually be there a little bit. So might take a while to get there. See all these slides I could have gone through with you? Are you happy I didn't?
Yeah.
So Prashant might not know. There usually is a thing, I wonder if it was I can find. Anyway, sorry. There usually is a thing that shows our tactical asset allocation. You might have went by it. Sometimes they switch these things on me. There it is. You're not going to be able to see it. So in this, you'll likely see that our largest, I wonder if there's a laser, I love a good laser. Our largest weights continue to be in the US, right, on a relative basis. We are overweight to EM, that type of thing. So I think there's the merit that in the S&P I get some global diversification. I'll share with you that, and I think this slide reflects it. When it comes to developed markets, we're not as bullish. We're actually underweight. So our global benchmark is ACWI. And so we are underweight international developed. We believe that despite the fact that they're cheap, that in many instances, some of the policies that they're undertaking are in the right direction. Greater fiscal integration, defense spending, etc. But it's not showing up in the economic and earnings data yet. But that's different on the EM side. Where on the EM side, earnings growth in EM is expected to be around 20% this year. Now, we'll see, given what's happened with the oil price shock, particularly for kind of net importers of oil in Asia and other areas, how problematic that would become, and does that kind of ratchet down those earnings. But we feel like EM gives us some diversification benefits, leans into economic, kind of diversification, rising incomes, better demographics, greater structural reform. We can still get access to AI through Tencent, Alibaba, Taiwan Semiconductor, South Korean kind of semiconductor companies, etc., and provides us some diversification. We believe that in this structural change, if in fact the Fed does cut rates, the dollar weakens, inflation eventually falls, should we be able to get past this price shock? But those are all historical tailwinds for EM. So our view is, again, that kind of at the margin, we're still most overweight the US. It fits with that kind of narrative, but that question. That is where the innovation is. That is where the earnings growth is. That's been demonstrated again this earnings quarter. We're underweight to international developed. We think that they continue to demonstrate some structural challenges, but we're willing to take a greater overweight to EM for some of the reasons I cited. This is kind of how we think about it at this point. In terms of the second question, if companies do not have to provide guidance as frequently or choose not to based on changes in regulation, I don't think it'll have a broader impact on longer term or intermediate term returns. What I do think will happen is it may introduce some element of volatility without some of that information. right? So again, as all good CFAs and all this other stuff, we've known over the years that what's happened with more information, more guidance, whether it's the Fed or anything else, companies, that all of that information, in my view, there's been times, remember 2017, where like, where's all the volatility? There's no volatility, everything's kind of compressed. I think that all that guidance and communication and forward guidance is going to compress that volatility. So I guess in a very long-winded way, what I'm saying is without it, I'd expect some more variance around kind of earnings results and things like that, should they not have to provide it. But I don't think it changes things structurally. Remember, of course, Reg FD, right, happened. You know, I grew up in the industry, right? The analysts used to go to the CEO, and the CEO would tell them kind of what's going to happen before. They make some changes, and they announce it. That all went away with Reg FD. I didn't think it had a major market impact. It just had more of the inner workings. I think it'd probably be something similar. Other questions? Yes, sir. I see your hand. I'll get you in a second.
Could you not briefly some of the comments you were making about emerging markets and developed ex-US? I know you're not an economist, but could you talk a little bit about currencies? We talked about interest rates, but a little bit more about currencies. Any thoughts on that? And maybe is that a significant component of return if you were looking at a stock that trades in Japan?
Yeah.
You can say like if you're in Japan, you get a lot better than if you're in the US.
Yeah, of course. As
Nothing
US.
specific. I'm not asking specific currency.
Yeah, no, I appreciate it. So, of course, as US-based investors, those non-US allocations, unhedged, benefit from a fall in the dollar and a rise there. Right? And that was a big, right? So many of us, right, are following and investing and doing these things. And of course, last year, for the first time in a long time, both international developed and EM outperformed. Also, one of the things that happened for the first time in a long time was the dollar fell. Right? And that certainly flattered returns from that perspective. So part of our thesis is now the war in the Middle East has, in our opinion, temporarily disrupted the trend in the dollar. And we think that the dollar is likely to weaken over the intermediate term. Now, again, we'll all long be retired, hopefully, and things like that. The dollar is not losing its world reserve currency status. We're not suggesting that. We're not talking about anything to do with that. But what we are suggesting is that shift from efficiency to resiliency. One of the outcomes of that change will likely be a weaker dollar. So as companies, as countries turn more inwardly focused on their own domestic kind of fiscal spending, defense, and other things, they're likely to issue more debt. They're likely to buy less treasuries at a time when we're going to have to continue to increase the supply of treasuries. We think that this will have a kind of a weakening effect on the dollar. Now, many will remember from 2002 to 2007, the dollar declined by 35% over that time period. So we think something like that over something a time period could do that. It'll flatter those international returns for US-based investors. That's part of our thesis, part of our thinking. Could be wrong, of course. As I said, I do. My crystal ball is as murky as everyone else's. But we do think that the structural dynamics, the deficit, kind of the fiscal dynamics that are at play are likely to lead to some of that decline, which should flatter those international developed EM allocations. It's part of the reason that we believe that this could continue. And look, that's the other thing is, as it relates, and I know you weren't suggesting, hey, which currencies, things like that, but when we think about this, we think about, okay, if all of these folks are debasing their currencies by issuing more debt without an ability to pay for it. Again, look at what's happening in the UK. Right? Starmer's about to resign. He's getting pressure to resign, and a more left, it's not political, but a more progressive coming in. They're not going to address the fiscal imbalances. Right? The advantages that we all have is that we can kind of change the weighted average maturity, the supplemental leverage ratio. We can change pension regulations and different types of things. There's some things that we can do to manage the curve where other countries are inhibited. And that has real problems. And we're seeing that play out in real time in the UK. And so kind of our view is that these currency impacts will happen. The dollar will likely kind of weaken some, at least over the immediate term, given some of the dynamics. That should flatter some of those international EM allocations. But there's not a lot of alternatives. Sorry, that's where I was going. There's not a lot of alternatives. So this also fuels the real assets, right? So why are they're all debasing their currencies, but there's not a lot of good choices, right? You're gonna put in euro, you're gonna put it in pounds, you're gonna put it in yen, you're gonna put it in RMB. No. So gold, real assets, those types of things we think kind of also fit with that kind of currency dynamic. Sorry, it took me a while to get there. I should have copied. Yes, sir.
Could you share your thoughts on aging demographics across the world, increasing population growth, both from economic fundamentals and also just old investors that are older behave differently as transitions from one generation?
Yep. So the demographic question is an interesting one. So one of the things that I didn't address is around the labor market dynamics, which is kind of interesting, right? So in this transition that we're seeing, I have to come up with a way to define it. So, I don't like New World Order, and I'm not sure I love deglobalization. Any ideas, let us know. But when we think about this, one of the other consequences that's happening is that the labor market is doing something unusual. You remember Powell talked about this in August at the Jackson Hole Economics Symposium. He said that both the supply of labor and the demand for it are falling at the same time. And so that's due, in my opinion, to a few things. Tougher immigration policy, AI, and demographics. And so, and some of those are obviously connected. So I do think that the shift in demographics will continue to have this kind of odd impact on the labor market. And then when we think about how that translates, I just read this line, so I'm stealing it. Robots don't pay taxes, people do. And so again, when we think about this, our long-term expectation for interest rates and things, and I know that's not exactly what you want, but if you have a kind of aging group of folks who are not, kind of paying as much taxes and you're spending, we think that at some point that means you'll get elevated rates from that. And those elevated rates, right, like all good CFAs, the value of stock, bond, real estate, or any other investments, the present value of future cash flow is discounted discount rate. That discount rate is going up. It's likely to slow economic growth. It's likely to be disinflationary as a result, but it's also likely to result in a re-rating. Timing is who knows when, right? So, but that's just how I kind of think of that dynamic. In terms of the second part, in terms of behavior, I think many of us, particularly in the kind of the wealth management field, the high net worth field, read all about the massive intergenerational wealth transfer that's going to come. And there's a lot to unpack there. We speak in broad terms. That's what's fun about being a strategist. So, boomers love their stocks, they love risk, right? They don't really shift. Will those dynamics change in the future? It's hard to tell in terms of risk appetites. But overall, I don't see that having as major of an impact on kind of returns and asset allocations. But I do believe the other component of demographics can have a component on fiscal situations, lower taxes, the labor market, ultimately leading to the potential for lower growth, which is disinflationary, and higher rates, which could be a challenge for risk assets. Lower returns in the future, I guess, is probably. When we talk about EM, we're banking on a little bit better demographics. Now, of course, China, right? It's folks who suggest that China is likely to go from 1 billion people to 800 million or something over the next couple decades or something, right, due to aging demographics. But other parts of emerging markets have better demographics. That's part of the kind of thinking or allocation there from a different standpoint. Those demographics and less social safety nets compared to Europe and the US and the UK, and therefore kind of provide a better kind of opportunities. Did you have a question? I don't mean to call. I saw you have a question.
Well, actually, to piggyback off of Matthew's question. Yeah, with the all other strategy, we like the framework of rising growth, falling growth, rising inflation, falling inflation. Is there sort of a third dimension in your mind? It seems like in the past at least 2 years, maybe more, that the dollar dynamics is that a third dimension where it's like we've seen this a lot where the S&P will go down, but international goes up. So it's not like growth on, so EM, EFA, S&P are up, but we're actually seeing correlations change there. So there's another sort of axis to the problem now, long dollar, short dollar.
Yeah, I think that's a way to think about it, and certainly it again kind of affirms our view. So we're not, quite sure, right? But it affirms our view that boy, the U.S. has dominated returns for most of this period, and American exceptionalism. Is that changing under these dynamics? Is a weaker dollar part of that as these folks kind of look more inward, right? Of course, one of the other things, another kind of symptom of this change was Mark Carney's speech at Davos, saying, hey, all of us middle powers are not comfortable being trapped between the US and China, and we're looking to one another to create trade pacts and security pacts and technology pacts. And to me, again, it all fuels and feeds into that, and I do think that is one of the other dynamics that's at play. But I haven't thought of them all, but saying like kind of, there's a lot of different things, right, in terms of rates, inflation, dollar, and allocations, et cetera.
Yeah. And then to add on to that, we think this has been a hypothesis of ours, for the longest time, stocks and bonds were uncorrelated or anti-correlated because inflation was just a sleeping bear that was never going to rise again.
Yeah.
So it was all just, is growth positive or is it negative? And if it goes negative, then lower interest rates, it's all taken care of. Can't really do that anymore. But now we're seeing this more, it's like dollar goes down, US stocks, US bonds are down, international real assets are up, so there's a new seesaw.
Yeah, I think so. And I think what I'm trying to reflect, and I'm teasing myself, self-deprecating, maybe not well, is kind of to lean into that, allocating a little bit more to things like EM, real assets, precious metals, to kind of lean into those dynamics. Okay? So we believe in that direction. Now, we recognize the limitations of our forecasting skills, so we still own a lot of US stocks, right? And this is where the earnings growth is. So this is, the US will be a destination for capital, because this is where the innovation is. This is where the growth is, the rule of law, the liquidity, deep markets, deep credit markets. So we don't think that's changing, anytime soon, overnight. So we, like many of you, we have a healthy allocation to the US. And that's why I say, what we're talking about is not throwing out the model, but making important tweaks to recognize these shifts, including some of the ones you mentioned.
Well, if anything, it can help stabilize things.
Yeah, that's what we think. To adjust to what we think is a newer environment that's here to stay. We don't think we're going back to globalization with low rates, benign inflation, global cooperation, free trade, the U.S. providing the national global security for everybody. We just don't see that. And so as a result, we need to make some modest changes in order to kind of reflect that new worldview. And some of the things that are happening in terms of returns that we're seeing. We think that this, so the way I think about it is just think of it this way, international and EM had just 1 year, exaggerating a little bit, but when we look at the last 15 years or so, I think 13 out of the last 15, US has beat international and EM. So we literally had just 1 year of this. We think it's maybe a bit more of a sustainable trend. Now again, all of a sudden, you get the war, right? And all these countries in Asia who import tons of oil, now they're they're not in trouble, but this is going to be a dynamic we'll have to deal with. We think it's probably somewhat temporary, but we don't know. And so the things change. But all of a sudden, all those countries in Latin America and other parts of EM who are net exporters of resources and oil, and you're like, okay, we should benefit, right? So kind of making adjustments and thinking about it.
Sorry, Don, but does that in effect make sort of global equity investment? You know, it used to be sort of a broad brush, and now as things are sort of fragmenting, it's becoming a more truly diversified mix as opposed to risk on, risk
Right,
off.
and so I guess for me, absolutely, and so I guess for me, the big takeaway here in many instances is that what's happened due to returns and behaviors and different things is portfolios that we see are massively allocated to US large cap technology companies. And we think that at the margins, we need to begin to try to address some of that. Now, if you're at a US, if you're dealing with taxable investors, it's hard, right? They have massive tax gains that you have to address, right? Things like that. And we're not suggesting that we, change this all overnight. Again, I just want to make sure that you do whatever you want, but I'm not suggesting that you throw everything out. As I mentioned, technology companies delivered 50% year-over-year earnings growth, close to 30% revenue growth. And all the fears of all these AI investments, at least so far, have proven to be unfounded. And the market's kind of move on. We're kind of seeing that a little bit. You see on the sustainability. But yeah, like portfolios that we see are not positioned in that way. They're positioned for the U.S. exceptionalism dominance tech to continue in perpetuity. And all we're saying is that might be true, but you probably want to make some adjustments around the edges to reflect what we think is this shifting environment. Did you have a question?
No, well, I think yeah. So it's a big worry with all the CapEx spend of the Mag 7, and then everybody's kind of obviously gotten over it and thinking about all the benefits to companies and the return on investment. And so, can you talk about like how quickly you think that that's going to happen? And then you work for a company that's like the largest labor-intensive company in financials, 50,000 people that they say is labor-intensive processing. Are you like, you go to work every day and you're like, nothing's really changed? Or are you like, oh my God, they just let go of 2,000 people and they've got Anthropic doing everything that a person used to do? Like, do you see it or you don't see it, and how fast do you think it's going to happen?
Couple things. And again, I know a few folks have taken the opportunity to exit. If you're being polite, don't worry about it. I'm not offended. If you got to go to work, you got to do stuff, again, please feel free. In terms of your question, so interestingly, there's the Census Department suggests that less than 20% of the companies in the United States, based on a labor-weighted metric, have made any meaningful investments in AI. So just think about that. So to me, what it suggests is that the runway and the opportunity remains dramatic. Right? You might say, oh, well, see, like the return, nobody's going to use it. I say, boy, only 20% of the companies, according to the Census Department, have made any meaningful investments on a labor-weighted basis. That's interesting. The second thing in terms of, I'll do other companies first, then I'll do our own. It had to be about a year ago now. Walmart reports earnings, they beat top and bottom line, I think they guide higher. And they're doing the analyst call, and the CFO gets on, and he talks about Walmart is doing an inventory catalog. So imagine Walmart, it's the largest retailer in the world. Imagine how many items this thing is. And so they say that they used artificial intelligence to help them do this inventory catalog. And without it, it would have been required 100 times more than human capital. That was a year ago. When we look at healthcare billing companies, right? And you think about kind of all these, I always often say on any of the major kind of highways and stuff, you get these a lot. There's these healthcare billing, right? So insurance, your doctor, who pays what, the copay, there's all this crazy rules and all this other stuff. It's about a $300 billion a year industry. And the executives in that industry believe through the power of AI if they can kind of synthesize all the rules and get AI to do it more efficiently, they'll increase their margins by 40%. And so they're going to do it. So those are kind of two practical examples of things that are happening already. I want to write, so it's funny you bring this up. I write an article, not when the mood hits me, like when I have time. And so one of the things I want to write about is like, I always miss my timing. Like all the skepticism and fear and AI wasn't going to work. I tend to try to write something that kind of offsets some of that. So I was going to actually use all these different examples from different industries about how it's already having positive impacts to offset. Now all of a sudden everyone loves AI again, so I miss my time. Right? Final thing about our company, so right, like when we're talking about, so this is a little different, this is more digital than it is AI, but it's certainly within the same arena. So when digital currencies came on, we all started talking about the blockchain that supports digital currencies. I'm like, State Street, so we work in the investment management side, but the bigger part of the business is custody. And I'm like, if you have an individual blockchain with somebody, you don't need a custody manager. Don't tell the CEO of my company, right? Like, you don't need that, right? Like, we're not there yet. So we recognize the threat and are making significant changes to the way we operate. And also AI is a component of that. And sadly, where we can do this with less people, we make those decisions. So when you ask me, do I see that? Do I feel it? Absolutely, I see it in things. I'm not like bragging or being goofy or anything like that. Sean and Kevin know, like, the stock hit 156, it hit an all-time high a few weeks ago. Part of it's reflected in this strategy towards kind of this efficiency, and that's being rewarded by the markets from that standpoint. So we do see it in that regard. So absolutely. All right, I'll take this last one, Tyson, and then we'll call it a day. I'm gonna get the hook.
It's one more on globalization.
Yeah.
Most of us grew up in a free trade and trade. The U.S. protecting global supply chains is obviously describing well the global supply. But fast forward to 2022, Peter Zalon's work on, I'm sure you're familiar with that, it's a very grim picture where the U.S. steps back to the constraints on human capital, financial capital, no longer having the capability or really knowing the supply chains, creating a fairly grim picture of the rest of the world.
Yeah.
That seems to not be, maybe to reconcile that with your outlook.
Yeah, so I'll try to do it this way. One of my favorite books is The Rational Optimist by Matt Ridley. So I know it's kind of read it. And the whole premise is around this idea that people often kind of do these grim kind of forecasts, right? And you mentioned a few of the works, right? So there's folks that suggest, we've discovered most everything, and the benefits from those gains and efficiencies and growth behind us. There was others that said, boy, once the global population reaches, 9 billion, we're all going to starve, right? We're going to run out of food and oil, right? Oil scarcity is, of course, was that. And so what Matt Ridley kind of outlines in the book is that under the conditions at the time, if we just stopped and stayed stagnant, those forecasts would probably come true. But somewhat serendipitously, you can say that, we had the kind of fracking kind of innovation that allowed America to gain its energy independence. So this oil shock from the Middle East, right? In the 70s, we'd be lining up at the pump, we'd be rationing. Other countries are doing that. We're like, oil efficiency changes, regulating, all the stuff. We're like, I'm not saying it's not impacting anyone, but it's like, yeah, it sucks if oil's, $4, gas is $4 a gallon, or whatever. It could go higher, and maybe I don't go out to eat as much, or whatever. Like, I'm not diminishing the pain. If I earn less money, it hurts more, but boy, this is a much different. So the whole premise on that is many of those forecasts are based on like, under these conditions, should this happen, right? So of course the one was the one that came out during the AI fears by the research, citrus, serene, thank you. Right, it's doom and gloom, terrible thing. So I just think that, yeah, if the conditions, but they don't. We innovate, we change, we get lucky, like things like that, and that results. So the way I've been, that's where I was going to go, and I promised Tyson I'll be quiet. Christian will get me, he'll drag me out of here. To your AI question and everything as well, people ask me about the jobs, similar to your demographics and things like that. So look, in the 19th century, the US was an agricultural economy. We figured out how to yield more crops and food off of a smaller footprint. And those jobs went away. Now, again, I'm not trying to be a jerk. It's not good for the farmers. But then the industrial economy came on. Manufacturing, and we moved into cities and all that created a tremendous amount of jobs. At some point, manufacturing represented 35% of the labor force in the United States. Today it's 12%. So as we figured out how to manufacture better and more efficiently, all the globalization took moment. Sadly, lots of folks in Michigan, Ohio, and other areas lost their jobs, right? That's sad, it's terrible. But the economy continued to expand, and we now are in the digital economy. So AI is gonna absolutely create enormous value, and it's gonna massively disrupt operating models, and people are gonna get displaced. But I think new jobs and things like that, and new methods and new things will be created, at least I'm hopeful, on those things. So that's the way I kind of think about some of that work. I don't know, maybe it helps me sleep better at night, I don't know. But that's how I always frame it. And that book by Matt Ridley, The Rational Optimist, has a lot of good kind of framework around thinking about it that way. So, all right, I probably have to go. Thank you so much. Appreciate it.